We've never been as pregnant with savings, but there's no confidence to spend them.
It's just, unfortunately, the people in charge of the country have done such a consistently bad job.
We will literally have no market left in 10 years.
So what? You don't have trust in banks, you don't have trust in systems, in government. So much of this just comes down to trust. And I think we don't have that.
The problem for investors in the UK is that the US has done so well over recent years. The US is the hot, cool kid at school in the teen movie, but the thing for investors to remember is maybe it's the under-the-radar, more nerdy kid that wins in the end, and that could be the UK stock market.
That's still the big opportunity on a sort of 3 to 5 year view. The big opportunity would be...
Welcome to Investing Unlocked with me, Georgie Frost.
And me, Simon Lambert.
We're joined today by Clive Beagles, Senior Fund Manager at Hambro Capital Management, co-managing their UK Equity Income Fund. He's seen it all, from the cool Britannia of the 90s to today. Undervalued, overlooked, out of favour. The UK stock market's been described as cheap for years. Is it time to back Britain again? The government would certainly like us to, wouldn't they, Simon?
They would, indeed. They have launched a new campaign to get you investing, Georgie.
Why? What's wrong with the UK? And what's wrong with investing?
There's nothing wrong with investing, and there's nothing wrong with the UK. The problem for investors in the UK is that the US has done so well over recent years. The US is the hot, cool kid at school in the teen movie, but the thing for investors to remember is maybe it's the under-the-radar, more nerdy kid that wins in the end, and that could be the UK stock market.
OK, Clive. The UK stock market, the nerdy kid that wins out in the end. The FTSE 100 has been hitting records of late, and yet it's still got this idea, this narrative. It's seen as out of favour with investors. Why is that?
Well, I think, as Simon said, US, quite frankly, has trumped, no pun intended, has trumped every single other stock market around the world by quite a considerable margin in the short term, not necessarily over the longer term. So the UK is no different in that regard. So I think that's sort of part of the agenda. And I think the other issue we clearly had ever since the referendum in 2016, there's been a number of political hurdles, shall we say, to kind of overcome in terms of people's perception of the UK, whether it's economically or politically. And on top of that, you've had UK investors kind of disinvesting, becoming more global in their outlook, but that hasn't been offset by international investors buying the UK because of what they read and perceive about our dear old country.
I want to go further back than 2016. I want to go back to the 90s. Cool Britannia, when, I don't know, how would you define cool Britannia? Like the Labour landslide, Blur and Oasis, this sort of thing. We were cool. The UK stock market was riding high. The economy was doing well. What changed?
Yeah, well, it's that era when it felt like London was the cultural centre of the world. It's Blur, Oasis. We were very much in the epicentre, if you like. But at the same time, financially, we were sort of, similar, commensurate with what was going on in New York. And I think when I started my investment career, it was actually slightly embarrassingly, the 80s rather than the 90s. But at that time, UK was 15% of the world index, second largest stock market in the world. Everyone had to have an allocation. It was a badge of honour to be listed in the UK. Companies aspired to list in the UK. International mining companies came to list in the UK. And that was the kind of world that ran all the way through the 90s, really. And compare and contrast that to today. Today, I think we're only the 7th or 8th largest stock market in the world. The value of the UK market is less than 2 or 3 individual companies in the US. And it feels like the badge of honour has become a badge of shame. Companies are desperately trying to get off market, either by delisting to go to the US or being vulnerable to kind of take over incoming M&A from overseas corporates and so forth. So it's been a very, very dramatic change in that regard. And I guess it's sort of interesting that, that period of cool Britannia was during kind of previous Labour administration. And here we are a couple of years into a current Labour administration, and the narrative doesn't seem to have yet reverted back to the kind of previous era.
I want to talk about that narrative a bit more because, Clive, you have suggested in the past, and you're sat here with 2 financial journalists here, that the financial press and the press generally might have a little part to play in a little bit of the surrounding negativity. Yep. Is that a bit of an easy cop-out, though?
Look, it's not the whole reason, but it is quite a considerable part of that. I talked earlier on about investors, particularly international investors. They look in on the UK. They've seen lots of noise and around politics. They've got Elon Musk telling them that London's burning and all this kind of narrative, which is clearly nowhere near the truth. But the reality is, I don't think the financial press evenly reports the news in the UK. Yeah, because there was a story a short time ago where there was a day when the IMF came out and downgraded their economic forecast for every single country in the world, by the way. But if you'd read the news or watched the news, you think the UK was the only country that had been downgraded. It was the lead story, front page news, or 2 or 3 minutes of every single news broadcast all over social media. The very next day, the UK's February GDP number came out, which was 0.5% when people thought it was going to be 0.1%. Massively better than expected. Could you find that amongst the news material that got released the next day? It was story number 14, I think, on the BBC website. And ironically, what it showed was that we had that sort of slowdown in the UK in the run-up to Rachel Reeves' budget, but actually, in the end, it was a kind of clearing event, and actually the economy was getting back on the front foot. This was obviously all pre the war. And obviously things have changed since then in terms of the uncertainty of the war, but it's just this lack of even-handed reporting. I'm not asking for people to overly emphasise the kind of glass half full attitude. Just report both sides of the story. And I'm afraid that kind of glass half empty attitude, it does, and linking to what you're probably going to ask next, does it matter? Yes, it does matter, because it influences investors' thoughts about the UK and, critically, consumers' confidence. Consumers in the UK, in aggregate, are awash with savings. I'm not suggesting every single household is, but the aggregate numbers, we've never been as pregnant with savings, but there's no confidence to spend them. And that's partly because every time they digest, however they digest the media, every time they think they read a story about the economy, it tells them it's gloomy, miserable. The kind of doom loop narrative just becomes somewhat self-perpetuating. So, we're all in this. Maybe I need to get out more, other people need to get out more. And you sound like an apologist for politicians, and I'm not trying to be. I'm just trying to present the facts. And the facts are not as gloomy as the financial members, maybe not you two, but members of the financial community would suggest.
Simon, a lot in that, but I have to ask you, as a member of the financial press, explain that, why we would have a situation where you would report, some negativity. And we know negativity, I suppose, sells a bit more, doesn't it? But actually, in this instance, when it has such an impact, do you take that criticism?
I would take that criticism, and I do think that there is a glass half empty attitude a lot in this country, but then I would say that that's a very British thing, to be glass half empty.
There is that.
And it's a very American thing to be glass half full. You sit there and you talk to, you sit down in a meeting with someone from Britain and someone from America, just look at the difference of the way they talk about what they've done. In America, it's totally okay to massively big yourself up and be like, I did this, and I did that, and I did that, and I did that. If you did that as a Brit, it would just be like, yeah, okay, that guy. So I do think there is a cultural issue there.
Yeah.
I think you have to detach. These two things don't always, fit together. Because interestingly, you were talking about Cool Britannia of the late 90s, the sort of 96 period onwards, right? Now, actually, if you then go after that into the 2000s, there was a period of time where London was the place to be. Everybody in the world wanted to be in London. It wasn't New York, it wasn't Paris, it was London. All of the rich were coming to London. We were concerned about so many rich people moving to London, driving up house prices, bankers were doing great, massive bonuses being paid out, everyone was absolutely swimming in money. The stock market wasn't doing that great at all. In fact, it took forever for the FTSE 100 to regain its pre-dot-com bust peak. We sat there going, oh, it's going to do it, it's going to do it, it's going to do it. No. It's down again, To go to the economic figures, I think one of them is monthly GDP. And I think monthly GDP numbers, I don't think we should be reporting monthly GDP numbers, because monthly numbers swing around wildly and so on. But I do take the point. I do think that there is a desire to champion the UK, certainly amongst the financial media and certainly amongst the press at large. It's just, unfortunately, the people in charge of the country have done such a consistently bad job dating back years and years and years. And I'm not just talking about this administration, I'm talking about the one before them. And it's got to the point where there are so many things in the tax system that we're shooting ourselves in the foot constantly, that I think we need to sort of just do that almost like, clean slate. We're going to throw all this stuff out the window, move on.
I want to dig into some of that, the policy, the tax, eventually, but I just want to pick up on something you said about, rich people were coming to London, the UK was awash with money. There's an issue for people here with what the UK markets actually tell us about what's going on in the UK economy. A lot of people aren't really sure that actually it doesn't necessarily reflect what's happening in the UK economy. So I think now's a good time, Clive, for you just to basically give us a lesson in, how the UK markets actually work. What do they tell us about the UK?
Yep. So we look at the UK market, it's basically a global index with an unusual sector split, of which 70% of the profits are generated outside of the UK. So it's the most international sort of single country market in the world. That sounds like a bit of a contradiction, but I hope you understand what I mean by that. And only 30% are made by profits come from the UK. And in particular, the FTSE 100 is particularly dominated by large international companies. You think about pharmaceutical companies, mining companies, oil companies. Some of our banks are domestic, some of them are international. The big key difference, I guess, between the UK index relative to other indices in the world is it has got a very low weighting to technology, particularly compared to the US, but even compared to some other, Asia or indeed parts of Europe. And I guess the areas that we're more heavily weighted to would be commodities, financial services, and which is of course a key kind of strength of our economy going back over hundreds of years. And in that respect, that how it's described by many people is it's a sort of index that's overweight in the value factor. I don't want to get too technical about that, but it's got less perceived to be kind of structural growth companies and maybe more mature companies that have been around for a while, generating plenty of cash, can deliver a sort of regular distribution of dividends out of their cash flow and can grow, but maybe not as dramatically as maybe some international companies, but equally have very strong and secure positions in their own markets. The part of the UK that would be more aligned with what's going on in the UK economy would be more the mid 250 index. So that's full of the medium-sized companies. So in the UK, that means anything from maybe £500 million market capitalisation up to about 4 billion. That's much more domestically orientated. It will have lots of house builders in there, retailers, media companies, some of the sort of smaller financial services companies. Markets are supposed to be a sort of forward indicator of what's ahead of us. And if you're looking for sort of the markets kind of as a bit of a voting machine, and if you're looking at what the voting machine's saying about the future prospects of the UK, maybe looking at the 250 is a better way of thinking about the 100. Because of course the other thing about that FTSE 100 being so international is those earnings could either be higher or lower depending on whether the currency is strengthening or depreciating. Whereas again, you don't get that dynamic as much in the 250.
So if the FTSE 100 is, I suppose, the outside of the car, if you want to take a look under the bonnet or inside the car, what does that tell us about the picture of the UK over recent years?
So the FTSE 100 has regained has gone to new highs. More latterly, it may have come off with some of the uncertainty around what's going on in the Middle East. 250 has struggled more to get back to its high. It was beginning to perform much better as we experienced a series of reductions in interest rates because inflation was under control, interest rates were coming down, and that process was expected to carry on during 2026. And to some degree, there's been a sort of slight roadblock put in the way of that, courtesy of Mr. Trump, Iran, oil price, and potential increase in inflation. So in the short term, that's maybe getting in the way of that what looked to be quite a nice trajectory, which was that cost of money was coming down. Back to some of the previous comments I made about consumers being very sort of awash with savings, but just not having the confidence to do that. As rates come down, you would expect people to begin to spend some of those savings because for two reasons: they won't be getting as much money, in terms of interest, and actually maybe they might even begin to take on a little bit of debt because the cost of debt are beginning to fall. So in the short term, that's kind of got it slightly in the way, but that's still the big opportunity on a sort of 3 to 5 year view. The big opportunity would be, and we shouldn't forget, 2/3 of UK GDP comes from consumer spending. Yeah, you wouldn't believe that really when most people talk about we want to have a AI powerhouse, or we want to we want to drive our biotechnology industry or whatever else. The thing that's really going to move the dial in the UK is consumer spending. And we've got the opportunity to do that, but partly due to some of the sort of political own goals, interference, we haven't created enough certainty to allow people just to get on with it. And we just need our politicians to just get out of the way. Yeah, and they've failed for 10 years to do that, unfortunately. But at some point, one would hope they might do so.
Do you think as investors we put too much focus on the FTSE 100 and we should be looking more at the FTSE 250 and even at the smaller companies below that?
Yeah, to a degree, I think that's right. But we can't offset the fact that internationally, it's happened everywhere, actually. Larger companies, whether they're in the US or whichever index they're in, have been outperforming mid and smaller sized companies. There's been this sort of quest for liquidity. It's partly been driven by index investing, I think, and plus as well as a sort of assumption that the kind of all the riches will go to the kind of the largest companies around. So it hasn't been a uniquely UK. It's been a bit worse because of some of the economic issues we talked about. But everywhere, mid and small cap stocks have been underperforming their sort of larger peer group in that regard. And it does make up 85% of the index. So you can see why it should probably 85% of the time should probably be spent talking about it, I guess, in a way.
But as an active fund manager, do you find the 250 and that sort of area more interesting?
Way more interesting.
Do you look at
no. If you look at the fund that I co-manage, it's 50% in FTSE 100 and 50% in mid and small cap. So we're very heavily weighted towards the mid and small cap area because A, the valuations are much lower there. Secondly, you can really kind of roll your sleeves up and get to know the companies. We sort of engage with our companies 6, 7, 8 times a year, and you can do that much more easily with smaller companies. And ultimately, you're more likely to find a significantly undervalued share in that part of the market because there aren't many other people looking at it, not many other people owning them. That's where you're likely to find your outsized returns and winners coming from, rather than, well, where's my value add in AstraZeneca relative to everyone else? I mean, sometimes you may have an edge in one particular aspect, but you're unlikely to have a dramatically different view and edge compared to the broader market there.
What are you looking out for, Clive?
We are trying to find fundamentally mispriced stocks. Our fund has quite a heavy sort of recovery type tilt, I suppose. So what we're trying to find are what you'll never find. You'll never find fund managers going out saying, you find they buy bad companies, okay? Most fund managers go, I buy quality companies, and they think that's what people want to hear. No one goes and says, I deliberately buy really bad companies where things can only get better. But actually, to some degree, we do a bit of that. And we don't buy fundamentally bad companies, but we might buy companies that have been somewhat undermanaged or mismanaged for a period of time, where actually there's something might change or improve, or it may be that the sector they're in has had a particularly bad hit from the economic cycle or some external event or whatever that may be, but where actually at some point in the future they're likely to be better managed and the returns they can generate are likely to be better. And because everyone's become very focused on the here and now, momentum and immediacy, no one's looking forward more than 6 months, 9 months, 12 months. When I started, back to the previous conversation, people looked forward a couple of years, and we talk about normalized earnings. So under more normal market conditions and more normal levels of quality of management, what could a company generate, how much profit could it make, and what sort of multiple are we paying for that, rather than where are we right now. So that's what gets us excited. If we can find stocks that might only trade on, these are going to sound ridiculously low numbers, 3 or 4 times normalized earnings, if they can deliver those normalized earnings at some point in the next, let's call it 5 years, then by the time we get to there, the shares probably will be on 12 times earnings, which we might have made 3 or 4 times their money. I make it sound very simple, and it isn't quite as straightforward as that. But that's the principle. That's what we're trying to capture. A lot of people don't do that anymore. Most people in my world who were what's called value investors, doing the stuff we do, were all encouraged to retire. Were given a tap on the shoulder in the last decade. And why was that? That was because, of course, the previous decade was the era in which interest rates effectively were zero for 10 years. Okay, and so it was all about growth, because you could put very high multiples on future profitability because the cost of money was very, very low, and that became the sort of trendy way to invest. That, just to be clear, that's the only decade in the last 100 years in which growth has outperformed. But unfortunately, we now have a generation of people who think that's the only way to invest. Whereas actually, over time, value, boring as it might sound, buying average companies that might get better rather than seeking the euphoric kind of excitement of growth companies, doesn't sound very exciting, but actually, traditionally, it's given you much better returns.
Before we carry on, a quick word from our sponsor, PensionBee. If you're listening to this podcast, chances are you care a fair bit about investing and making the most of your money. But here's the thing, you don't have to be a pensioner to care about your pension. In fact, the earlier you pay attention, the more powerful it can be. Your pension is likely to be one of, if not the biggest investments you have, yet it's often the one people ignore the longest. That's where PensionBee comes in. They're a leading online pension provider focused on helping people build confidence and take real control of their retirement savings at any stage of life. Their app and website make it easy to combine old pension pots, manage contributions flexibly, and see exactly what's happening with your money all in one place. You can also access your pension from age 55, rising to 57 from 2028. If you want to take a more active role in your pension investing, download the PensionBee app or visit their website to get started. Remember, when investing, your capital is at risk.
There's been a wave of takeovers. That's one of the major things that's defined the UK market. And there's sort of become this phrase within the investment world of, if you don't buy it, they will, which sort of describes this thing of like the share prices of some of these companies are so low that if investors won't buy them, then somebody just come buy the whole thing. With some of these companies that you're looking at, where they are on very low valuations, do you look at them and think, why are people not buying these?
Yes, but they probably haven't got any of that momentum that I talked about. You know, as I say, it's probably that people just find it, you know, the sector they're in challenged or disinteresting, or they just don't look at the attribute. You know, they don't look at the fact that XYZ company might be trading on a discount to its own freehold property assets, as an example. Yes, so in which you think, well, why is that the case? Shortly, you know, that feels like I'm buying the whole franchise of the business for free, which you are in many cases with a whole raft of companies in the UK. But actually, people aren't looking at it through that lens. They're just looking at the kind of earnings momentum. Need something that looks a bit like tech, or which isn't going to get disintermediated by AI or whatever else it may be. So it's a double-edged sword for me, the takeovers, you know, because at the current rate of takeovers in the UK, we will have no market left in 10 years' time. Okay? And I've said that to politicians.
And what do they say back?
They sort of like look a bit scared and got to shuffle their papers and kind of try and change the subject. We will literally have no market left in 10 years.
So what?
So
what? So what? We have no market. Go somewhere else.
Well, you think
we're
about
investing in the US anyway, aren't we?
So you think of what happens to our accountancy, legal professions, all those ancillary services. Financial services is one of our core has been one of our core strengths. You know, what is the stock market's purpose? The stock market's purpose is to be a way in which companies can raise capital. Companies that deserve capital can raise capital to grow and expand and you know, both organically and inorganically. And it's sort of lost its rationale. It's suddenly become a mechanism by which companies, you know, go to die, if you like. Remember there was an FT piece written by a hedge fund manager, which pretty much marked the low of the UK market, by the way, in which he described the UK stock market as Jurassic Park, the place in which companies go to die. Literally marked the low of the market, both in relative and absolute terms. But it's become this sort of, you know, all companies are sort of being encouraged to do is just buy back shares, sort of shrink to grow and this kind of stuff, rather than get on the front foot. And we want our companies to be on the front foot. Back in the 90s, that's what the mechanism was. It's for companies to expand. If we don't have our own domestic stock market to do that, I think we will struggle to generate companies that are doing that, and therefore the tax take over time will be much, much lower. And we're worried about sustainability of our public finances anyway. And if we lose all our listed companies, and the answer isn't that they should all be in private equity, I don't think. You know, private equity has some attributes, but it has some negatives as well. You know, the governance that naturally comes with the listed stock market, I think, is very important. Give you an example: would Thames Water have happened if it was still a listed company? Would it have been 8 times levered? Would it have? No, because it wouldn't have been allowed to be. But you know, out of the spotlight of listed markets, you know, companies do kind of somewhat different things. I'm not sure private equity had very good returns during the last decade. We've already talked about why that was, because interest rates were very low and leverage juiced up their returns. We're not going back to that world, so I'm not sure that's the answer.
You touched on an interesting point there, and it's one that we get asked a lot. Is what benefit is it to a company being listed on the stock market if its share price goes up? So, for example, Tesco. Tesco's share price is up substantially over the last 2 years. Now, Obviously, that's a benefit to Tesco's executives who benefit from share options and things like that. But Tesco will continue to be a successful supermarket selling huge amounts of stuff to customers, whether its share price is £5 or whether its share price is £3. What benefit is it to Tesco as a company of its share price riding high?
Yeah, well, a couple of things. I suspect in the case of Tesco, I suspect thousands of members of staff probably own shares. Yes, in terms of the kind of employee share scheme. So, and for them, actually, shares going from £3 to £5 is probably quite a considerable increase, and probably because the lack of direct investing in the UK, it's probably easily their largest investment they've got in the quoted stock market. I think so. I think there's that benefit, and if at some stage Tesco wants to expand either internationally outside of the UK or into a tangential, business operation, then it could use its shares as a currency, if you like, and if they're very well rated, then actually, if you like, they could buy. I'm not saying they could go and buy a US food retailer or they buy a European food retailer and use their shares as a currency in order to do that and become even more powerful because suddenly they're obviously their purchasing economies of scale become even larger and it would cement their dominance, if you like. So those I think would be the two main reasons that I'd call out.
You mentioned about the rise in index investing, the government's campaign, obviously, to try and get more ordinary folk with those savings that you spoke about, Clive, to spend a little bit more of that or invest a little bit more of that. The danger, obviously, is if they do just throw it into a global tracker, for example, that 60% or something will go to the US, a huge amount of that will go into tech. Do you see the rise in that sort of investing as a bad thing for smaller companies? Because as you said, not that much money is going to go into them. Or do you see it almost as perversely, I suppose, a good thing for you?
No, I don't think it is a good thing for us because there's just a lack of positive money flow into UK equities at the moment, and particularly the smaller end of that. So yes, those companies might end up getting taken off market. You may get a short-term sugar rush from a premium, but actually the companies are probably still going out on the wrong valuation. So I don't think it is positive at all. I do think we need.
Is it negative?
I think it is negative. I think there are things that I think, again, back to that kind of government ministers or whoever else or advisors shuffling papers when you tell them there's going to be no stock market left. Yeah, there are a couple of very big issues around that they need to think about and tackle. One is whether they should mandate and say that there's a minimum amount of pension funds that should go into UK equities. It's very unpopular. We give £52 billion every year of tax relief for money that goes into pensions. £52 billion, okay? And at the moment, about 4% of that ends up in UK equities. So let's call it 2 billion.
Yeah.
So 50 billion goes into Apple, Nvidia. Now, it's fine for those individuals. They've done very well out of that. But how have we need to have a bigger, more grown-up conversation. How have we, as a country, benefited from giving £52 billion of tax relief? Have we encouraged any development or growth in our own domestic company base? No, we are the only, other than the US, where the market's so large relative to the economy, we're the only major developed market that's not overweight its own domestic market. France, Italy, they're 6-7 times overweight their own domestic market. Australia, even more so than that, and they use incentives to do that. And I'm not talking about people should be forced to put 50% of their fund in, but I think there should be a minimum, because ultimately we're trying to create companies that will grow, employ people, create tax revenues that will help support the country for future generations. And no one's prepared to have that bigger conversation. They just want to say, I don't want the government to tell me that I've got to invest in, Northern Ireland shipbuilders, therefore it's a terrible idea. I need to be allowed to make my own investment decisions. And I get that, but they miss the offset of that, which is we are going to have no stock market left unless we do something radical. Just slowly, we are literally sleepwalking into oblivion. That is what we're doing. And no one seems prepared to take a decision.
The issue with mandation, just to talk about that, I think is how I see it, potentially more about the fact that we already have a voluntary agreement in place between, I think it's 17 of the largest pension funds, to put a minimum amount of the investments into private equity. What the problem is then politicians saying, well, if that doesn't work, we have the right to make you do that.
Sure.
And I think that doesn't sit well, certainly, with a lot of people.
No, but sure,
but you're
sure,
saying
no,
actually
no,
really difficult
but
decisions
I
need to be
get
made.
that, but that's fine. Well, I'll tell you what, I'll say, okay, Georgie, you don't want to put 10% minimum of your fund in UK equities. That's fine, but you're not getting your pension relief, tax relief. Okay, so you can still do it. Yeah, you're perfectly within your own rights to put it all into the US stock market because you still think it's going to, I'm not having a go at you, by the way. You still think it's going to double and triple from here, but you're not getting your pension tax relief. There's nothing wrong with that. The choice is yours. Tax relief, invest a minimum in the UK, no tax relief, you can do whatever you like.
Imagine any government politically doing that. I just can't even.
Well, I mean, you could do it in two different ways. Firstly, I think you have to detach what Clive's suggesting from what the government is trying to do. And I think the controversial thing that the government is trying to do is trying to get people to put money into infrastructure and private assets. If the government was saying 10%, in order for your fund to qualify for pension investment, 10% of it has to go into the UK stock market, that would be a different story because those are listed companies and that's very different to investing in private assets, illiquid private assets, right, which are arguably unsuitable for most investors. But I think also there's then that element of you say, well, if you look at our pension system and our pension tax relief system, we limit tax relief to certain people. We start limiting the amount of tax relief that people can have. Maybe you provide people with the element of extra tax relief on that, but the deal is your money has to go, maybe larger than 10%, 50% into UK equities. I mean, for all, and I wasn't a great supporter of the idea of the British ISA, right? Because it was adding complexity.
Explain what that would have been.
The British ISA was going to be a way of trying to encourage people to invest into the UK stock market. And it was going to be an extra allowance on top of the £20,000. It was going to be £5,000. That was the idea. On top of the £20,000, and that could, but it had to go into UK equities. There then became this question of, well, what counts as a UK share? Is it an investment trust, right, which invests all around the world? But arguably, the investment trust is still a UK company. It might invest all around the world. How different is that to BP or something like that? But that was a better idea than what we have ended up with, which is the government saying, well, you can only put £12,000 of your ISA allowance into cash and the other £8,000 has to go into shares because the other £8,000 as it stands is going to mainly go into the US stock market.
Yeah.
Right. Even if people did invest that money and people don't, all they hear is ISA being cut. You've got to remember that most people do not engage, right? So you're undermining the system anyway. But even if they did invest the other £8,000, as it stands, what is happening and what has been happening for the last 5 to 10 years is that money's going to go into the US stock market. So maybe you are better off saying, all right, you can have your extra tax break, but there's a caveat. There's a deal here to be done, and that money has to go into the UK stock market. It's not, it's not a terrible argument, but I do think you need to detach it from the private assets infrastructure stuff.
And as you can tell, I'm not in agreement that the private asset thing should be mandated because of what I said about reduced returns in the last decade. And we shouldn't forget what ISAs were originally single company PEPs invented by Nigel Lawson. That was all supposed to be about wider share ownership, but they've metamorphosed into tax avoidance cash interest kind of schemes, 40 billion a year going into cash ISAs. It's not what they were ever intended to be. But of course, getting off that kind of train, if you like, is a difficult process.
There's another element here that I think also we should do more of, which is I have always thought that we do not do ourselves a favour by focusing on the stock market index and the index price. We quote the FTSE 100 all the time, but there's also the FTSE All Share. But we quote it on the index price, and you look at it and you go, well, it's not actually recently it has gone up quite a bit, but before it went up quite a bit recently, you go, well, it's gone nowhere in 3 years, it's gone nowhere in 5 years. But actually, people have had a really good return from it because of the dividends. And if you take the dividends paid out, you compound the dividends. I think we should be, or the people in charge of the stock market, the government, etc., the authorities should be promoting us looking at the FTSE Total Return Index, which shows those dividends added in. But actually, as a punter,
Yeah.
if you go looking for the FTSE Total Return Index, you can't find that anywhere. It's very difficult to find the level of it. You need access to something like a Bloomberg terminal or a Reuters terminal to find that.
Why is that? Because you've made a very good case for it.
I presume people just think it's too complicated. It isn't very complicated,
Right.
yes, but I think that would be the answer. Of course, because the US hardly pays any dividends, it doesn't suffer from that. So that kind of gap between the S&P and FTSE 100 can be seen to have got wider. But let's not forget, for the last couple of years, the UK has actually outperformed the US, yes, in sterling terms. We haven't talked about currency at all, yes. Part of the reason that returns from the US have been so strong is because until recently the dollar's been so strong, so you've had a double benefit. Actually, that's beginning to unwind, courtesy of the US looking like a slightly less
Is it going to
less
really
predictable
unwind,
partner.
or is it just a little blip in the road?
Well, UK sterling dollar's now unchanged over 5 years. Yeah, it started at 135 roughly, got down to about 105, and we're now back at 135. That's the 30% blip in the road. That's quite a big number in that respect. So, and on most sensible measures, purchasing power parity, whatever else, what does it cost you to buy a Big Mac in the US versus elsewhere in the world? The dollar still looks overvalued. And as I said, they clearly are a less reliable economic partner, political partner than they've been at any stage in the last a long time anyway. So it would be surprising if the dollar didn't continue. And it's also got the worst government deficit of any nation, any developed nation in the world. It's been allowed to get away with it because of the dollarization. So this sort of end of US exceptionalism, which began to get talked about a couple of years ago, it's talked about less, but just quietly, it's sort of happening away from technology. Yes, and because technology, people forget that the US technology sector fell in 2022 when there was no longer free money around and interest rate went up. It fell by about 50%. But it then bounced back very sharply because suddenly we had the AI trade, and that's given people a whole new narrative to kind of get on board with. But it can go down as well as up, and it's done that quite recently. Yep.
Do you think that was almost the perfect time for people to turn their attention to the UK, given everything you've just said about the US?
Now is the perfect time.
Yeah,
well, I think it's a decent time. I mean, the valuations are still modest. I mean, the UK market has begun to do a bit better. We've talked, but it's still just about the cheapest developed market in the world, and it has plenty of breadth in terms of the kind of type of companies that we talked about. The mid and smaller cap companies we mentioned earlier on are particularly sort of out of favour, unloved. So I wouldn't discourage people. We're not saying they should have all of their money in a single market or a single stock, certainly not, or a single fund. But actually, it should be part of the conversation. If
you do want a bit more UK in your portfolio, how would you go about doing that? What should we be looking at?
Well, there's one or two quite well-run active UK funds around. I'm sure you might know one or two of those. That's an option. I mean, obviously, people could. You could just use an index fund. I mean, we've already talked about the fact that larger companies have outperformed, so that may or may not be the right thing to do, but it's obviously a cost-effective and easy way to do it, and it's better than leaving it in a cash ISA, on a long-term view. I'm not making a prediction about what happens in the next weeks or months, but on a long-term view, it clearly makes more sense. And as we talked about, you can generate a dividend yield that's probably commensurate with what you're getting in cash anyway. So in that respect, it would be you could do that. You could find one or two kind of specific funds. I do think people, obviously people have a varying amount of investment knowledge. I think it's from the UK is people think they know about companies, and so they start buying them individually, and that's a bit dangerous. The job I do is, we get lots of things wrong, and we do it 100% of our time. And there's a lot of people who do it 10% of their time and think that they're adept at it. And I'm sure they get some things right, but it's quite hard to consistently. And people tend to forget about the things that aren't working out and so forth. So I think I would encourage people to use funds or indices rather than do it with individual shares.
And is that quite easy to do, Simon, in terms of buying funds?
I mean, it's incredibly easy to do. We could sit here finishing this podcast and I could open an account and do it on my phone while I was talking to you.
Lovely.
And probably not break too much from the conversation while I was doing it. It is unbelievably easy to do nowadays, but there is a couple of things that happen. And firstly, you have the inertia of people opening an account. Now, so you need an account with if you're going to do it yourself, the easiest, cheapest way to do it is with a DIY investing platform, right? There's lots of them. But then people get a bit paralyzed by the choice. They're like, oh, which one do I go for? But there are many of them. They're very easy to use. You Google it. You'll find plenty of articles explaining ones that you should use. If you're a beginner, choose one that's easy for a beginner. You open it up, do it in an ISA because then your gains are tax-free. Mm-hmm. Always try and do it in an ISA. There are very few reasons why you shouldn't use an ISA if you are just investing in stocks and shares or putting your money into cash, right? And then you simply just go for the easy options. There will be ways that help you choose the easy options. And as Clive said, the simplest thing to do if you want to invest in the UK stock market is you choose a FTSE. I would say go for a FTSE all-share tracker. Don't go for a FTSE 100 tracker because then you're buying the whole market. But you do need to be aware that if you open your investment account and you put your money in and you put all of your money into the FTSE all-share tracker, you are massively overexposed to the UK stock market compared to the global market. So maybe you put half your money into a global stock market tracker and then the other half into the UK, okay? Keep Clive happy, right? But if you want to buy individual shares, you can do, but maybe just do that with a small chunk of your money. So you put 80% of it into funds that are nice and simple, and with the other 20% of your money, you buy some shares. But you need, if you're going to buy individual shares, it does take work. You do have to keep on top of it. You need what's referred to as a diversified portfolio. Don't put all your eggs in one basket. What that basically means is that you need to hold at a minimum 10 to 20 different companies, and they need to be companies that do different things. Yeah. It can't be like 10 to 20 companies that all do the same thing, because then they'll all go up and all go down. It
sounds like the
time.
US stock market.
Yeah, exactly. But it isn't that complicated. It is very simple for people to do.
But look, just to play the contrarian, when does unloved and undervalued just become accurately valued? Because we've been hearing for so long about it's cheap, it's unloved, it's underperformed the US stock market. When does that just become, that's its value?
Well, as I say, it's outperformed the last 2.5 years. It's outperformed the US, UK. No one's noticed. Yeah, no one's noticed at all. If you look at sort of performance of markets, you need to be very careful because you had a lot of disruption with COVID, especially. So obviously markets collapsed into March 2020 and then had a roaring recovery when the vaccine got approved in November. But very different types of shares did well in different times. So for the first time, you can now look at like a 5-year period of time as a fair comparison about how markets have done or individual managers have done. Our fund, full of relatively moderate quality, or the other way, UK listed companies in the 5 years to December 2025 outperformed the Nasdaq. Not many people know that. No, but that's my point. Is that no one's got any idea. No one's got any idea whatsoever. Now, not the whole UK market didn't, yes, but there are people out there. We're not alone. There are other people with a sort of value tilt who've produced similar returns, and that's despite all of the negativity we've had over that 5 years. How many prime ministers we have? 4, I think. I mean, I've slightly lose count. But it's so just quietly, and it hasn't been because the currency's gone down. Actually, even as currency's actually strengthened over that time. I think the process has already started, and people are very slow to pick up on it, and because all they just see about is NASDAQ and the S&P and rah, America and all that stuff.
Also, I would add to that there was a point probably, 18 months, 2 years ago, where that idea that actually the UK was not undervalued and unloved and was just accurately valued started to be being made in a number of places. And that was almost the exact point of the sort of capitulation where that was the time to buy. Yeah. It was like when everyone had given up, that's the time to buy.
So, Clive, I know you are a man who has been making the bull case for the UK, not just UK equities, the UK for decades. You can see just in this conversation now that in defense here of financial journalists, it's quite easy to slip into the negative. It just seems to be compounding almost, the increasing in tax, et cetera, et cetera. So still, finally, with a bit of positivity to end the show, Clive, come on, make the case for the UK and think, if you were the Chancellor, still time, Clive, if you want to do it, by the way, there might be an opening for you. Clive, make the case for the UK.
Well, I think we've talked about about many of these elements about sort of getting out of the way. I think some of what they've done, relaxing, trying to get planning moving, getting rid of NIMBYism and so forth, I think has been quite positive. It just sort of slightly hasn't been followed through upon because it's not house builders want to build more houses. There just isn't any demand currently because of all the uncertainty that's been created by a lot of the issues that we've talked about today. So it's about trying your best to create as much certainty as you can do. People, again, back to the kind of lack of reporting. The UK deficit this year is going to be 20 billion lower than it was last year. 20 billion lower. Actually better than where people forecast. Around June last year, people were talking about being 20 to 30 billion higher. So the numbers are actually moving in the right direction. Our kind of debt to GDP ratios amongst the G7, we're either in second place or third place out of the 7, and Germany are an outlier, so compared to everyone else at the top. So it's just about trying to create this sense of competence, control, certainty, and whether these characters can do it or the next lot, time will tell. But you've got the raw ingredients. But back to what we said, does all this? We talked a lot in this podcast about all that element. We haven't talked very much about the companies. Yes, this can impact companies, but most companies just get on with it. They've had so much stuff thrown at them in the last 5, 6, 7 years. They've had to address so many cost increases and issues. They are incredibly lean. The companies that have survived for this long in the quoted arena are in general, very well run, very lean. Just a modicum of an upturn in kind of demand, and you'll see some really positive operational gearing in terms of the kind of type of profitability they can produce. And the multiples you're still being asked to pay for them are really quite modest. You look at the fund that we run, it generates about a 4.5% dividend yield. We've grown that dividend yield by 9% per annum over 21 years. So if you'd invested in our fund 21 years ago when we launched, when it yielded 4.5%, if you still owned that unit today, effectively the dividend you receive this year would be a 29% yield on your original investment, or you've made 7 times your money. Okay, and that is in a market in which for the last 10 years it has very much felt like we've been running up a down escalator. Just so imagine how good those returns could have been if they hadn't been running. And I don't want the escalator doesn't have to go change. It just needs to flatten out, and make life. And I think there've been some signs that it's a bit of back and forth, but that started to happen a little bit. So you can make good returns out of unloved markets. You just need to know where to look. You need to know which rocks to turn up and shine a light under, and try and find some underappreciated companies. And that's what we spend all our time doing. We don't get them all right. Absolutely don't get them all right. But if you can get more right than wrong, then the odds are so much in your favour in our world in terms of the types of companies that we're looking at, that when you do get things right, you can make some quite nice outsized returns.
Clive, finally, the £1,000 move. If you had an unexpected £1,000, if I were to give you £1,000, I'm afraid I won't, but if I were to, what would you do with it?
I've got to eat my own cooking, haven't I, given what I do for a job. So it's very difficult for me not to suggest that it would find a home in our fund.
Simon says,
I think, this was a very wide-ranging discussion. There's a lot of things to take away from it. But one of the things I would take away from it if I was an investor is that there are a number of UK companies, and there's quite a large number of UK companies that have actually delivered very good returns over the past, 5-10 years. And they have done that against a major headwind. So imagine how well they could do with a tailwind behind them. And also, yes, we've talked a lot about bad news, but I would say ignore the bad news. But actually, as an investor, you shouldn't ignore the bad news. You should actively look for the bad news, because the bad news normally tells you that there's something worth looking at and considering whether the news might get better, and you might make some very good returns off it. And I would give one example that people can go away and Google, and that is Rolls-Royce. Rolls-Royce had a lot of bad news around it. Go and Google how much it's up over the last 5 years.
Simon, Clive, thank you so much. And thank you for joining us. If you want to get in touch with us, you can find us on social or send us an email. Remember to hit subscribe so you don't miss an episode. And make sure to tell your friends who don't know their aims from their AUMs about us too. Before you go, just a quick reminder that everything you've heard on this podcast is for information and education only. It's not personal financial advice. Investing involves risk. And if you're unsure, it's best to speak to a regulated financial advisor. If you enjoy Investing Unlocked, especially our retirement episode, then I think you'll enjoy this from our sponsor Pension B, the Pension Confident podcast, hosted by Philippa Lamb alongside a panel of financial experts. It's aimed at those who want to understand pensions and personal finance in a bit more depth, but without the jargon. They cover topics like ISAs, mortgages, the bank of mum and dad, as well as how to become a pension millionaire and the cost of divorce. There are new episodes every month, plus bonus content in between. You can listen on all major podcast platforms, in the Pension Beat app, or watch on YouTube. Just remember, anything discussed isn't financial advice, and when investing, your capital is at risk. Search the Pension Confident podcast wherever you listen.